Hello, welcome back. Mike from Canavan Wealth. We are going to do the 2023 Midyear Outlook. So LPL just released their outlook titled kind of Path Towards Stability. You can get to it from the website here, just Market News, Midyear Outlook 2023. And this link will soon work. Right now, it just takes you back to the website, but you can get to the download right here, but it will eventually take you, should be fixed by tomorrow, to this page where you can also download it. Effectively, it's this PDF file. LPL, all sorts of most investment firms put out something like this. LPL's, I think, is no better or worse than anyone else's. As you'll see, if you get used to a lot of these, you'll understand that a lot of this is just dancing around words. But there were some really interesting things that I found. So, they title this kind of the path towards stability, and I think that this kind of goes along with the video I put out. I don't remember, it was a day or two ago about. It was just yesterday about interest rates and inflation, and how inflation does seem to be dropping, and that along with the Fed kind of signaling that they think that they are done raising interest rates, that, or at least pretty darn close, that those are kind of the two things we needed to have in order to kind of move on from the past economic cycle to what I think is going to be, kind of seen as a different time period in the economic period, and that they largely kind of mirror that here. This is just really going over kind of what they kind of general overviews. They do say baseline forecast is effectively a mild recession in late 2023. I'll believe it when I see it. I find it hard to believe that when you are predicting a recession, of course, this recession was predicted back in 2022, still hasn't happened yet. That if your time frame is plus or minus a year, I don't think it's the same recession, right? I think now we're predicting, the 2022 recession never happened. If we do go into a recession, it's not going to be the same causes of the ones that we were predicting 18 months ago. So the commodity or the currencies is really interesting. It's going to be one of the last things we cover. So, all right, this is probably the first interesting thing of just kind of what the economic forecasts are for this coming year. So this is what they're expecting it to be at the end of the year. So GDP growth of 1.2% for the US, that's pretty low for us. We're typically up in the 2s or 3s, but if it's not a recession, we're kind of dodging a recession. 1.2 isn't too bad. Obviously, substantially higher than what they're predicting the Eurozone. Global at 2.3, so not too much further ahead of us. This is interesting. Now, it's interesting that this would have been most likely finished in the end of June, and they didn't have the last 2 weeks, even though it just came out recently. They probably didn't have the most recent CPI data because their target for CPI is 3.8, and we know that CPI, normal CPI, not core CPI, hit 3%. So we're actually already at this. And it'll be interesting when you see their kind of how they could have been wrong in this report 15 days later, what a difference it makes. Unemployment rate 3.7 still at the end of the year. So even though they talk about right here softer job market, unemployment rate, they're still not predicting to be budging much. So this is really just talking about how they believe small businesses plan to slow hiring, and that makes up, like, I think it's 45, yeah, right there, 45% of the market. So it's tough for me to. This really didn't seem that convincing to me, but this was very interesting on the housing market. So, God love LPL using dark blue and light blue for their graphs, along with black. So this is hard to tell, but you can. What it's showing is that this laying down here is multifamily units, effectively amount of investments going into multifamily units versus single families, and they have reversed very recently. So they're expecting kind of rents to get a little softening, a little help for those people seeking, to rent, because multifamily units are often apartments, townhomes, things like that, often rented, not owned. So they expect that to have a pretty big impact, which also ties into the video on inflation and about why Europe measures it differently. This is like the exact reason. Effectively, if rents start coming down, then we are going to start seeing our inflation come back down more dramatically, whereas Europe does not measure it that way. So this rent thing doesn't apply. So that's why they kind of view our inflation as already having come back down to kind of normal levels. this is just talking about share of spending effectively right here in COVID. Share of services, which is this top line, takes a plummet because you couldn't go out and pay for services, haircuts, things like that because we were all locked down. It really hasn't returned to kind of pre-pandemic levels. Kind of predicting that it will, but I don't know. Those lines don't look very convincing to me. That looks like we're going to bounce along here for a while. So what's the next thing? Oh, this was probably the best of it. So this is saying, what do they think the stock market's going to do for the rest of the year? Now, remember, at this point, the stock market's up, I think, over 15% for the year. So we've already got a really good start. We'd have to have a pretty nasty decline over the next 6 months in order for this not to come true anyways. But this is saying for years following a down year, 84% of years that follow a down year have been positive, and the average return is 15.2, which is right where we are. January trifecta. So this is saying in a year in which the Santa Claus rally period towards the end of the year is positive, the first 5 days of January are positive, and January is positive, then 90% of those years we get a positive year on average 17.4. Again, this applies to us. Midterm election year, so it's effectively saying the third year of a presidential cycle is typically good, 90%. Typical return, 16.8. This is also considered a new bull market. 92% of those, ultimately return on average 19%. And then this bear bull spread, which goes into kind of the weeds. But again, so there's all these indicators that will have a nice, good, positive return on average in this range, which we're really already seeing. So this is not a stretch, right? It does imply, though, that we could see a flattening for the rest of the year, which wouldn't surprise me at all. But we could also see kind of a new high on the S&P 500. And of course, we could be the outlier 10% in all of these and go through some type of unknown economic downturn and still finish negative for the year. Earnings was not real interesting. This is just saying that stocks appear no longer attractive relative to bonds. That's largely driven by interest rates. And when interest rates have been very low here, stocks are very attractive. This is all going to depend on whether interest rates stay, I'm not even going to call them high, stay average. And I think there's a pretty good chance that we start coming down next year. So we'll just have to see. Next one here. Oh, this was very interesting. So this is effectively these lines, these different color lines are the different times at which the Fed raised interest rates, the Fed funds rate. And then this axis is what was that interest rate over how many days after it? So for example, 111 days after they stopped raising interest rates, on average, they were like, either a half or 1.5% down. If you look over here, 260 days after they stopped raising interest rates, on average, interest rates were down 1%, which are treasury yields. So we're down 1%. So that's kind of implying that even if they don't start lowering interest rates, we would expect to see interest rates to be down about 1%, treasury yields at least down about 1%. Also, it's for that exact reason they expect bonds to do well after a pause, because if interest rates lower, old bonds do better. Oh, and then down here, I really want to talk about this foreign exchange. So, reports of the dollar's demise are greatly exaggerated here. There's this talk that, the yuan is going to take over, the Chinese currency is going to take over the dollar in dominance, that the dollar is kind of struggling, but they give this statistic, and this is foreign exchange turnover. So what this is saying, effectively, if you look at every time someone exchanges money, how often does it include a certain currency? And 90% of the time, it includes the dollar. So if there's money exchanging hands somewhere in the world, currency to currency, right? I'm trading in my X currency for some other currency. 90% of the time, it's one of those two currencies is the dollar, and that's just something that is so hard. Can it be eroded? The forecast says, yeah, it can, but it would take years, and we certainly have not seen it. Has it come down? Yeah, like the tiniest little bit. Has the Chinese currency come up? Absolutely, but when you're starting from zero, there's only one way. You can kind of only go up. So in what I was kind of surprised is not in this. They actually talk about how China's reopening and their economy's coming online, and they somewhere in here I must have skipped through it. They talk about they don't expect that to add to inflation. What they don't talk a lot about is, which we've talked about here, is the weakening of the Chinese economy in so many ways. A number of weeks ago, we did one on unemployment in China. This is talking about um, foreign investment. So this first quarter, foreign investment in China was 20 billion. Last year, first quarter, it was 100 billion. And Goldman Sachs, it's here somewhere. Goldman Sachs predict outflows from China this year will cancel out investment going into the country, meaning more investment money will leave China than will enter it. Chinese will invest in other countries more than other countries will invest in them, which has not been the case for over 40 years. Then it just goes through all the reasons, which is can largely be paraphrased as the Communist Party and their policies scare the heck out of businesses. I saw this firsthand when I used to work in the potato industry here in Idaho Falls. All sorts of the potato companies here in the US wanted to produce and sell in China, and none of them were moving towards it because of their fear of intellectual property being stolen. Largely the way they cook their potatoes, the way they process them. Surprisingly, I should do a video on the potato industry, but surprisingly, like the number of places where potatoes are grown in the world is not that much, and there are very few very knowledgeable companies that know how to process potatoes effectively because of some very weird traits about potatoes. And none of the companies wanted to go build plants in China because they were worried that effectively the Communist Party would seize those plants or start overseeing them in a way in which they would be able to steal that economic advantage of potato expertise. I know it sounds crazy, but it is absolutely a thing in the potato industry. So that is what I was surprised they didn't talk about, is because it's got to be close here where they talk about what could upset it. And it must be further up, but they talk in here about kind of what are the things that could change that would effectively upset their predictions. And they're not talking about some major economic downturn in China that would have a very detrimental effect on the rest of the world. So that is really it. We'll jump back here to my slides so I can give you my standard disclosures. I hope you enjoyed the video. I'll probably do this every 6 months when LPL releases their outlooks, and I will talk to you soon. Thank you.